Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another podcast. This is episode 101. This is our 101st episode, so I'm excited to be here with each and every one of you. And again, can't thank you enough for the time, the devotion, the loyalty that you have given us for the past 2 years. We're excited, as always, to be here, and this is episode 101 of Your Tax-Free Life. A couple of weeks ago, I talked a little bit about the Rule of 72 and the importance of understanding the Rule of 72. And for those of you that have not been able to hear the podcast, the Rule of 72 pretty much dictates how long will it take for your investment to double based on a given interest rate. So if you'd recall, the Rule of 72, you take the 72, you divide it by the interest rate. So if you're getting a 10% interest rate, you divide 72 into 10% or into 10, and it would tell you that it would take 7.2 years or 7 years and 2 months in order for your money to double. Then the next question is, well, what if we want to find out how long it would take for your money to triple and not just double? Then instead of using the Rule of 72, you're going to use the Rule of 115. And the same thing you're going to be able to accomplish. So you take 115 into a given interest rate, and then it will tell you how long it will take for your money to triple. So let's use the same interest rates that we used in the in the Rule of 72. We used the 4%, 6%, and 8% interest rate. So if we take 115 and divide it by the 8% interest rate, your money would triple in 14 years and 4 months. So it would be 14.38 to be exact. And that's important to know because based on the type of risk that you're willing to take and the amount of money that you're willing to set aside and your tax situation, whether you're going to be taxed as a capital gain or as an ordinary income, then I think it would be important for you to know how long it will take for the money to triple. Let's say that instead of being 8%, you want to figure out how long it would take for your money to triple at a 6% interest rate. And then obviously once you do the calculation, you realize that it's going to take 19.17 years, or just rounded off to 19 years and 2 months for your money to triple at a 6% interest rate. And if we go down to the 4% interest rate, then it's going to take 28.75 years, or 28 years and 3/4 of a year for your money to triple. Why do you think that's an important factor? Why do I think that's an important factor to understand and to plan for? Is because once you reach your retirement age, whether that would be 60, 65, or 70, your money's going to have to triple in order to address all of the retirement issues and concerns that you're going to be facing in the future. Whether we talk about future taxation, inflation, loss opportunity cost, interest rate volatility, susceptibility to consume, long-term care issues and concerns, obviously, because if you have a long-term care issue and you don't have that taken care of, then those additional expenses are going to have to come from your existing retirement assets. So therefore, it's going to be critical for each and every one of you to understand that in retirement, whether you want to or not, especially if you want to live a good retirement life, your money's going to have to triple. And the better that you know how to prepare for that, now does that mean that you're going to take all of your assets and put them in the 8% interest bucket or the 10% interest bucket? No. you're going to have to do, depending on the type of risk that you're willing to take. You're going to have to divide those investments between the 8, 6, and 4, or it could be 3, 5, and 7. So it really depends on your individual situation. It's also going to depend on, the standard of living that you want to maintain. How much money do you need to keep your standard of living alive? Do you want to purchase an annuity in order to guarantee a given standard of living, or if you want to take care of your immediate income from a business perspective, then those are things that are going to be very critical for you to consider when it comes to your retirement distribution planning. So having a clear understanding of the rule of 72 and the rule of 115 is going to give you the preamble to make the right decision at the right time and for the right reasons from a business perspective. So, I thought it would be a good idea to, at least in the last couple of episodes, to talk about the rule of 72 and the rule of 115, because a vast majority of Americans do not understand how the rules work. So again, you're going to take either the 72 or the 115, depending on whether you want your money to double or triple. You're going to divide that by the interest rate, and then the answer will be the years that it will take for your money to either double or triple. Now, as most of you know, we're actually living through a very, very volatile stock market because of the coronavirus fears in the marketplace. I would imagine that there are other issues that are being taken into consideration, and the markets are going back and forth one way or the other. But for the most part, I do believe that it has to do with the fears of the coronavirus, and the market has been in turmoil. Now, it's something that we expected, but not necessarily because of the coronavirus, because we felt, and I feel very strongly, that the market is going to have to correct at some point in time in the future, because we have had a 10-year run at a bull market, and bull markets do not last on the average more than 5 years. So, we're actually due for a stock market correction. What I do want to bring to all of you, and this is something that you got to keep in mind, is that, number one, you don't want to have all of your eggs in one basket. Because if you do that, especially as you're approaching retirement, or for those of you that may already be in retirement, you're going to have a challenge if you have all of your eggs in one basket. Because you still need to maintain your standard of living. You still need to, address the issue of retirement. You still need to take money out at a point in time where you're no longer generating income. So you're going to have to live off the income that your investments are taking. And if your investments are taking a hit because of a market correction, then you may very well be compounding the problem that you have coming to you, not only now, but also in the future. The other issue is that, just because the market goes down 1,000 points and it recovers 1,000 points, it doesn't mean that your account, number one, went down by 1,000 points. Or that could be, in your individual situation, 10, 15, 20, 25, 30, 40, 50%. But when it goes up by 1,000 points, it doesn't mean that you recover 100% of, those losses that you incurred when the market goes down. And I'll just give you a quick example for you to keep in the back of your mind that will allow you to start thinking about how to protect your retirement assets in a way that you haven't thought of before. So if the market goes down by 50% in 1 year, and it goes up by 50% in the second year, what is the average rate of return for those 2 years? And in reality, the average rate of return for those 2 years is 0. The market went down 50, it went back up 50, so you have a 0 average rate of return for the 2 year that we're talking about. Now, I did use the word average because average is definitely not actual. So although the mutual fund companies are going to report that the 2 year average is 0, your rate of return may be higher or lower than that, or it could be at a loss. Let me give you another example. Let's take the same 50% down and then 50% up. which gives us a 0% rate of return. Well, let's add some numbers to it. Let's say that you have a portfolio that is worth $100,000. So in the first year you drop 50%. So you're now down to $50,000. And if in the second year you gain 50%, now you're only gaining 50% on that 50,000, not on the 100,000. So 50% gain on a $50,000 portfolio brings you up to $75,000. So, but you started with 100,000. So that means that although the average rate of return for the 2 years has been 0, your average rate of return on your portfolio has been a negative 25%. Because you started with 100,000, it dropped by 50%, so you're down to $50,000. And then it went up by another 50%, so now it brings you up, that $50,000 brings you up to $75,000. So you're still down $25,000 compared to where you started 2 years earlier. So in reality, although the average rate of return was 0 for the 2-year average, for you it has been a negative 25%. So again, the point that I'm trying to make here is that you cannot have all your eggs in one basket. A portion of your assets should be in guaranteed accounts. Now you could use a guaranteed annuity, you can use a fixed index annuity that you can still participate in the upside of the market. But when the market drops, you don't participate in the losses in the fixed index annuities. You start where you started. You stay where you started. So if you had a portfolio of $100,000 and the market dropped and that portfolio was invested in a fixed index annuity, you would stay at $100,000. So in the first year of 50% loss, you would have been at $50,000 otherwise. You're still at $100,000 inside a fixed index annuity. And in the second year, when the market goes up another 50%, that now brings your account value to $75,000. Now you would be north of $100,000 in a fixed index annuity because you never lost value when your account went down by 50%. So it's important to note that you need to have money invested in the market. Depending on your age, if you're 60 years of age, 60% of your investment should be guaranteed. If you're 70 years of age, then 70% of your investments should be guaranteed. And you can use a combination of fixed annuities, fixed index annuities, and then obviously traditional mutual funds in order to hedge your bet, your retirement bet from a business standpoint. For those of you that are very conservative, and you want to mitigate and you want to hedge your standard of living, and you want to maintain or at least pay for your fixed expenses on a guaranteed basis, then an immediate annuity may be suitable for a portion of those assets. But having 100% of your assets exposed in the market is not only dumb, but is also not very intelligent from a business standpoint. So just wanted to take a few minutes with you today, talk a little bit, do a refresh on the rule of 72, also bring about the importance of understanding the rule of 115. But last but not least, I wanted to touch upon something that is happening today with the coronavirus and the volatility of the stock market, because if you're in retirement or close to retirement, you cannot engage in volatility because you're going to lose 100% of the time. That being said, if you have any questions regarding what we've talked about today, please feel free to reach out to me. You can email me at Bert, B-E-R-T, at gablestaxgroup.com. You can also call me. Feel free to do so if you have any questions and or concerns at 786-766-1042. Again, 786-766-1042. And always remember that my goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks a lot for giving me a few minutes of your time, and I'll talk to you again next week. Take care. Bye-bye.